There's a very easy do-it-yourself method to investing that not only outperforms the vast majority of retail and professional investors, but also saves you a ton of time, energy, and money along the way. And that investing method is called, wait for it, the 3-fund portfolio. In this video, I'll show you what makes this way of investing so successful, the steps to properly create this portfolio in your account, which aren't always so obvious. I'll give you a list of the funds needed to create the portfolio, and then I'll show you the actual historical returns based on a few back-tested 3-fund portfolios that I put together. If you get some value from this video, then please hit that thumbs up button. If not for me, then please do it for my dog Molly, because she's staring at me right now waiting for me to get done filming so that we can go outside and play. The 3-fund portfolio is made up of, you guessed it, 3 different funds, nothing more and nothing less. As with anything, you can of course customize it beyond those 3 if you want, but the results may vary based on how many shares of speculative investments that you decide to add beyond those 3. The 3 types of funds consist of number 1, a total US stock market index fund, which essentially holds every single stock traded on the stock market. We're talking small cap, mid cap, and large cap stocks, which makes up around 4,000 US based companies. Number 2, a total international stock index fund that excludes stocks that are headquartered within the United States. These are stocks that make up developed and emerging international economies and are equal to roughly 7,600 different stocks. And finally, a total US bond market index fund, which consists of a mixture between maturities that are short, intermediate, and long term. In total, there's a little over 10,000 of these. When you own a total market index fund, you basically have money invested in essentially every single stock and bond traded on the stock market. Between these 3 funds, you'd hold a little more than 21,500 different stocks and bonds across the world at the lowest cost possible. You're instantly diversifying your money by only having to worry about purchasing 3 different funds. As Jack Bogle, the guy who introduced the first indexed fund to retail investors like us, once said, "Why look for the needle," meaning those individual winning stocks, when you can just buy the whole haystack? By investing in these 3 types of funds, there is zero overlap when it comes to stocks and bonds. Portfolio overlap happens when you invest in multiple funds that hold the exact same stocks, which in turn makes you less diversified than you might think you are. An easy way to remember this is, when diversification decreases, your risk will increase. Only having to own 3 different investments sounds pretty simple, right?
Yup!
Like so simple that you don't even need to pay one of those expensive professional advisors to pick your investments that'll most likely underperform the market over the long run, right?
Yup!
Did we just become best friends?
Do you want to go do karate in the garage?
It's no secret that advisors make money off of you because that's how they get paid. And the amount that they're paid comes directly from the returns of your investments. There's 2 main ways that they make money off of you. Number 1, by charging you either an ongoing percentage based on your account balance, which I've seen on average is about 1%, or a flat fee no matter the size of your account. And or number 2, by getting a cash kickback from the company that manages the fund that they're having you invest in. I don't know if you caught that, but it sounds like there might be a little bit of a conflict of interest for that one, right? Of course there is, but naturally, they're going to try to hide that from you. If an investment advisor told you to invest in the same 3 low-cost funds for the rest of your life, then would you be willing to pay them an ongoing 1% fee every single year? Would it be worth paying them $20,000 in fees? Because if you invested $10,000 today and paid them 1% per year for 30 years, then the total fees that you would pay from the annual fees plus the opportunity cost would add up to $19,800. Now, let me put that in terms that we can all understand. That equals 2,475 Chipotle burritos. Yes, you heard me correctly. You would pay more in fees than that initial $10,000 that you invested. I don't know about you, but I wouldn't be willing to give up over 6.5 years worth of daily Chipotle burritos for them to do something as simple as put me into a 3-fund portfolio. They want to make it as complicated as possible to make it appear like they're doing something productive with your money by constantly fiddling with your portfolio to justify charging you 1%. If they knew that you knew that it was as easy as buying 3 low-cost index funds, then they'd be out of a job, which is why you'll most likely only hear this sort of good advice from a fiduciary financial advisor, because they are legally obligated to act in your best interest. interest, and the trustworthy ones usually only charge a flat fee as opposed to an ongoing yearly fee. Not all non-fiduciary financial advisors are professional scumbags, but we do have to acknowledge the fact that their incentives aren't aligned with helping you make the best investment decisions. Investing in a 3-fund portfolio reduces the amount of time that you need to spend with and pay a financial advisor whose goals aren't aligned with yours. But avoiding a shoddy advisor isn't the only reason to use a 3-fund portfolio. It's also a good way to avoid the risk that comes from an active fund manager that's handling how money is invested within a mutual fund that you invest in. Low-cost total stock market index funds held within a 3-fund portfolio are passively managed funds, which means that the fund managers aren't choosing what to buy, sell, and hold. Actively managed funds, on the other hand, are run by people who are choosing which stocks to buy, sell, and hold. To successfully pick the right stock combo to outperform a basic total stock market index fund, these fund managers need to have some level of skill to achieve that outperformance. But time after time, the data shows that it's nearly impossible to successfully do this over long periods of time. The hot fund manager everyone talks about today turns out to be the loser of tomorrow that everyone eventually forgets about. In a paper published in the Journal of Finance called Luck versus Skill in the Cross-Section of Mutual Fund Returns, Fama and French found that on a practical level, our results on long-term performance say that true outperformance in net returns to investors is negative for most, if not all, active funds. In the paper, they did admit that when returns are measured before costs and expense ratios, there is stronger evidence of manager skill. But this is irrelevant though, because you're not getting into these funds without paying a fee. It's like saying, I have this awesome new electric car, but there's nowhere for me to charge the thing, so I can't really turn it on and drive it. All I can do is look at it.
Look at that. That's nice and shiny.
Which brings up another advantage that the 3-fund portfolio has. The 3 index funds that make up the portfolio are extremely low cost. The price for each can vary from fund to fund, which we'll cover in just a minute, but compared to most other funds out there, they're the lowest since they are passively managed. For example, the Vanguard ETF versions have an expense ratio of 0.03%, 0.08%, and 0.035%. That means for every $10,000 invested, you're paying an expense of $3, $8, and $3.50 per year. A study from the Financial Research Corporation called Predicting Mutual Fund Performance set out to determine if there were any ways to predict the future performance of a mutual fund. They tested 10 different predictors like past performance, Morningstar ratings, expenses, turnover, manager tenure, asset size, and a few more things. They came to the conclusion that the best way to reliably predict the future performance of funds was by looking at the expense ratio and nothing else. They call a favorable expense ratio an exceptional predictor for bonds and a good predictor for stock funds. Based on this research, if you want to pick a successful fund, then ignore everything else and just look for the one with the lowest expense ratio. And lucky for the 3-fund portfolio, those 3 total stock market index funds are about as low cost as they get. Hang tight, because I did all of the legwork for you by putting together a list of the exact tickers that you might want to use. I'll cover those in just a minute. It was cold in here and now it's hot, so the jacket had to come off. When it's all said and done, the biggest selling point of a 3-fund portfolio is that it's just easy. Literally, dummy-proof. Contributing money to your investment account on a regular basis and spreading that money among only 3 funds is easy. Rebalancing once per year across only 3 funds is easy. When it comes to withdrawing money when you're older, you only have to pick between 3 funds to sell off, which is easy. When choosing what to invest in, you only have 3 funds to worry about, which is easy. Investing isn't complicated at all, but for some reason, we like to make it out to be more than it actually is. There is zero correlation between spending a bunch of time trying to pick stocks or mutual funds, or spending a bunch of money on an advisor, and an increase in your investment returns. Successful investing has more to do with your psychology than anything. Stick with the 3-fund portfolio process and get on with living your life, because the returns will take care of themselves. The first step in building your 3-fund portfolio will be to choose the 3 funds that you'd want to use. Here's a list of the exact funds that you'd want to hold depending on which investing platform that you use. All you do is choose one from the total US funds, one of the total international funds, and one of the total US bond funds. Side note, if you're building this portfolio within a 401k, then you might not have access to a total US stock market fund. Now, if that's the case, then you should have access to some sort of S&P 500 fund, which you can substitute in its place. You don't have to, but I'd suggest choosing funds from the same row just to make things a lot easier for you. As you can see, all of the funds are exclusive to their respective investing platforms, except for the Vanguard ETF versions. Those Vanguard ETFs can be purchased on any investment platform, which is why they're my #1 choice. To the far left, you can also see that I've ranked each 3-fund mix. I did that because the more that I looked into each one, the more I realized that they are not all created equally. Even though the expense ratios for each fund within a category is going to be different, they're not far off enough to where I'd steer you away from any of them. The issue I have is that when the name of a fund says Total US Stock Market Index, I would assume that the fund would hold literally every single stock on the US market. The same goes for the Total International and Total Bond Index as well. But the more I started to look into each one, the more I realized that that's far from accurate. Most of these funds do not actually hold quote-unquote everything. Here's the same list, and next to each ticker symbol, I have how many stocks or bonds are held within each one. Based on this info, the only true US stock, international stock, and bond funds are the ones offered by Vanguard. That's not to say that you should avoid any of the others, but it's something to be aware of. The returns will most likely be pretty close between all of them, but if you want to get the closest return to the market as possible, then go with the Vanguard funds. Once again, the good news is that with the Vanguard ETFs, they can be purchased on any investment platform out there. The next step will be to choose an asset allocation, meaning out of 100%, how much should go towards each of the 3 funds. This is quite possibly the most important decision that you'll have to make, so pay attention, because it's going to have a direct impact on your expected return and risk level. The more risk you want to take, for example, the more stocks and less bonds that you want to hold, the higher expected return. The inverse is also true. So the less risk that you want to take, i.e. the more bonds and less stocks, the lower expected return. Here's a chart I put together showing you how different stock and bond allocations would have performed over the past 34 years. On the first line, the 0% stock and 100% bond allocation would have only netted you an average of 5.73% annual return. During the worst year, you would have only lost 2.66% with a max drawdown of 5.96%. On the last line, I tested a 100% stock and 0% bond allocation for 34 years. It gave us an average annual return of basically 10%. But, and this is a big but, you would have had to have been able to handle a worst year return of negative 38%, and a max drawdown of negative 52%. That means that if you had $1 million portfolio and you were 100% in stocks, then at one point you would have been down $520,000 and your 3-fund portfolio would be worth $480,000. Yes, of course your investments eventually recovered, but you need to ask yourself if you could handle that kind of drawdown on your portfolio and not panic sell. That point when the portfolio was down 52% was the housing market crash, which started towards the end of 2007. There were a lot of unknowns during that time, and looking back on it now, we know how things played out. But if you were in the middle of it, then you had zero clue if the whole financial system was going to crash. To make things even worse, your portfolio during that time would have been underwater for a little over 5 years and 2 months. Let me say that again in a different way. It would have taken your portfolio 1,885 days to fully recover from that $520,000 loss. So you need to ask yourself, could you handle not selling and continuing to invest during that time if you were invested in 100% stocks? Because to get that 10% average annual return over those 34 years, you would have had to have not sold and continued to invest money every single month, even when it looked like there wasn't any light at the end of that tunnel. That's one of the prices that you have to pay for that higher average annual return. Always keep that in mind. And I didn't even put in here data of other times it crashed too, because that wasn't the only time. There was another time where I think it was down like 43% or 48% as well. Based on the odds and history, we know that it's likely your portfolio will tank potentially like that at some point between now and when you disappear from this earth. If you want your money to grow in a meaningful way, then you have to have a decent amount of your money invested into stocks which means that times like these are going to hurt no matter what. If you don't think that you can handle huge swings like that, but still want to give your money a fighting chance to grow, then start with the 5, 10, or 20% bond allocation within your 3-fund portfolio. You're also going to want to continue investing even when times look really ugly in the economy and the stock market. When it comes to how much to put towards international stocks, this is a tricky one that's been debated so many times. Now, because of that, I refer back to Jack Bogle, the founder of Vanguard, on this one. For a long time, he was completely against allocating any money towards international stocks. His thought process was that if you already own a total US stock market index, then you naturally have exposure to international markets because a lot of those corporations do a ton of business overseas. But as time went on, he changed his stance a little bit. He ended up saying that he would be fine if someone held anywhere between 0% and 20% of their portfolio in international stocks. So do what you want with that info. If you're really not sure, then start out with something like 10% in international and then adjust it up or down from there. When it comes to rebalancing your portfolio to get your allocations back to where they should be, I would only plan on doing that once per year. Don't worry about doing it any more than that. One of my favorite investing platforms that I use and I love that makes the whole 3-fund portfolio investing a lot easier is M1 Finance. I'll have a link in the description of this video to check them out and also get a free $30 from them. Now it's time to implement this strategy for yourself. If you have any additional questions beyond what I've covered so far, please leave them down in the comments below and I will try to answer every single one of them for you. But there's 2 things that I really need to stress to you though. Number 1, it is extremely important to invest money into this type of portfolio on a regular basis. Consistency is key. The returns I showed you were all what happened in the past and do not give us any indication of how things will play out in the future. For all we know, the returns for everything going forward might be lower. Now, if that's the case, then the best thing that you can do is to shove as much money as possible into those investments on a regular basis. The returns of a 100% stock portfolio might only net you an annual return of 5% as opposed to that 10% that we saw. But I would rather be earning 5% on a portfolio of $800,000 than one that's only worth $400,000 because I wasn't investing on a consistent basis. And number 2, there's going to come a time, most likely multiple times, when things look very dark and grim within the world, the economy, and the stock market. I am talking really ugly. Kind of like when we were in the middle of the housing market crash of 2008. I need you to ignore all of that noise, continue to invest, stay optimistic, don't fiddle with this portfolio, and stay the course. Corrections and bear markets will come and go, but I can promise you one thing. If your 3-fund portfolio is crashing, then everyone else's most likely are as well. But the only people who actually lose money are the ones who sell or start messing with their portfolios during that time because they're the ones who are locking in their losses by doing those things. I've met a few people who sold their investments at the bottom of the housing market crash and still haven't fully put their money back into the market. Now, those people had to push out their retirement dates another 10 and 15 years because of that panicked decision. Make sure to hit that thumbs up button before you go. Check out the description for more resources and playlists to help with all of your personal finance and investing needs. I'll see you in the next one, friends. Done.